Tim, after a strong rally in the first quarter this year, we see the global markets have encountered some challenges due to hotter than expected inflation frame and geopolitical tension between Israel and Iran. Right now, the US 10-year yield is at 4.6%, rising more than 70 bits since the February low. Investors are now looking for clues on navigating these challenges. Today, we are honored to have two speakers with us, Mr. Wu Mun-tai, the head of investment services, Principal Asset Management Berhad. Mr. Wu joined Principal Asset Management as head of investment services in June 2018. He was previously the head of investment management and products with M Private Banking. Mr. Wu brings with him nearly 30 years of experience in the financial industry. Since 2000, he has served as a portfolio manager for both international and domestic equities. Prior to that, Mr. Wu was an investment analyst, having worked with a few global investment banks. Our second speaker is Mr. Yap Chi-Ken. He is the head of investment services at East Spring Investments Berhad. Mr. Yap Chi-Ken joined East Spring Investment Berhad in July 2018. Ken brings him with more than 24 years of experience in the financial services and asset management industry. Prior to joining East Spring, he was attached with CMB Principal Asset Management Berhad. Ken is currently overseeing the investment services, investment marketing, investment operational risk, insurance client relationship management, central dealing, and front office administration. Besides that, he'll be driving commercial outcomes and ensure that the fund management team has the support, tools, and assistance required to focus the necessary attention on achieving consistent investment outperformance for our clients while managing a transactional and system risk effectively. Can work closely with the CIO of East Spring and fund managers and manage relationship with external departments to ensure alignment to the needs of investment management business. Ken holds a Bachelor of Science in Aviation Business Administration from Embry-Riddle Aeronautical University, Florida. Let's start with the first question, Mr. Wu. The US market tumbled over the past trading days on stronger than expected US retail sales print and hotter than expected inflation figures, which might indicate a further delay in the US rate cut. The market is right now expecting 1 to 2 rate cuts from 3 rate cuts earlier. Compounding to that, the geopolitical tension in the Middle East has gotten hotter, with the latest comment by Israel saying that it has no choice but to respond to Iran's attack. Rising geopolitical tension in the Middle East could potentially lead to sustained high oil prices and other commodity prices, which may further complicate Fed's policy path. In this complex situation, Mr. Wu, how could investors navigate along the market?
Let me put it this way. If things get more complicated, it would mean the economy deteriorates faster. That means the momentum of growth usually would suffer because of higher oil prices, higher commodities, greater uncertainty. Nobody want to commit money to do investment with all this in the background. So effectively, what it means is the global economy will actually slow down faster this year, and that will also mean that of US. So for me, while we may see a extremely stubborn US inflation number, but so far for the rest of the world, we are not seeing that issue. Europe, even before this and even now, is still talking about the fact that their inflation is much less sticky. They are in inflation. They are in recession mode, and they're already talking about interest rate cuts. Although Europe may not be as important as an economic bloc as US, but I think that part of, let's say, if Europe to cut interest rates, it may provide some form of relief. It may make market a bit more palatable, but what it also means is market will continue to be volatile. If that is the case, I think the only way out of all of this is knowing your risk appetite, and you must definitely diversify. That's all I can say. And one more point to add, because of all this volatility and uncertainty, if there's a sharper than expected deterioration in the global economy, actually inflation in US and the economy in US is deteriorate faster, so that the likelihood of 1 to 2 cuts for US could still work out for this year. In principle, we have since beginning of the year talking about interest rate cut only in second half. We have not been like the market that says there will be cuts in March, May, and June. We generally do not expect that to happen. We were thinking earliest that it could happen is in August. The question now is, what is the probability of a cut in August? Would it be being reduced as of now? Then if that is the case, then there will be a little bit more complication, right? Of course, the geopolitical situation do not help, but unfortunately, both sides are not backing down, and and this is making life very difficult for everybody in the world. I stop here. Thanks.
All right, Mr. Ken, what do you think?
Okay. Before I start, let's just go back to the last 2 weeks in April and look at what happened. Now, on the 13th of April, Iran conducted a drone and the missile strike against Israel. That was in response to the suspected Israeli airstrike that destroyed the Iranian consulate in Damascus, Syria. And on the same day, the Iran Revolutionary Guard also seized an Israeli-linked container ship near the Strait of Hormuz. 5 days later, on the 18th of April, what happened is that Israel retaliated with what appears to be a limited strike against Iran. Now, fast forward to where we are today. So far, the market impact has been relatively limited to date, and the price of the Brent crude inched higher to about $92 per barrel following the strike. Yeah, and since then has fallen. Now it's trading around $87 per barrel right now. And if you look at the VIX index, which measure the expected volatility in the US stock market, which has risen to almost 6 months high from, I think, surging from 18 to about 21.5, and obviously it was a risk-off then. But however, if you look at it today on the VIX number, it has dropped below 16 as we speak. Yeah, so the market obviously is a risk-on again. So at East Spring, our team continued to monitor the Middle East tension for risk of further oil price volatility, higher energy-related inflation, and higher global trade costs, which is rising from the shipping costs. However, we don't think the global economy will slip into recession. It will take a very severe and sustained increase in oil prices to drive the global economy into recessions, which is not our base case scenario anyway. And while the oil shock will likely to keep the Federal Reserve from cutting rates, but we do not believe that it will compel the Fed to hike rate further from now on. So for now, the team believes that the global equity should continue to be supported by the resilient US economic growth in the near term. Having said that, over the next 12-month time horizon, the depleting US pandemic saving and the weakening labor market demand, among other things, are expected to slow the US growth further, which should be less positive for the equity overall. Now, the team would then position the portfolio more defensively beyond 12-month time horizon or over a longer term. Back to you, moderator.
All right. So, from what we gather from Mr. Wu and Mr. Ken, seems that this year the equity market could be quite bumpy. So, Mr. Wu, should investors actually shift their focus from equity perhaps to other asset classes like commodities or even fixed income?
I think fixed income is a permanent part of your portfolio. So the question now is whether you want to increase your exposure to fixed income or not. Commodity, unfortunately, a lot of times is generally tactical rather than having a strategic position. Of course, some people will take go as a long-term strategic decision, but usually it's not a lot. All right. So for me, there is play, like according to what Jigan said, there could still be room for play for equities, and also the fact that you still need to think of the fact that you need to have bonds, because eventually interest rate cuts will take place not only in US but across Europe and in the rest of the world. That will definitely be something positive for bonds as well. So for me, I think what is important at this point is the exercise of discipline. You cannot time the market, right? So you definitely need to be there, but the likelihood is you have to ask yourself how much risk you are willing to take. That's all I can say at this point, right? And for me, if things do not deteriorate, even though it slow down a bit more, actually it provides you with a nice little window to exploit to make money, but you must temper it with cut loss or take profit scenario lah, so as to make sure that you do not be overly exposed.
Yep, I think Mr. Wu actually pointed out that rightfully that investors will always need to exercise caution when it comes to every investment decision. Mr. Ken, seems that the previous argument that a rate cut could benefit emerging market and currencies may delay or may not happen probably first half of this year due to the rising geopolitical tension that actually led to the rise in DXY index. So, do you think that investors should actually focus more on the emerging market and currencies later part of this year, or since the market has already probably priced in some of the weakness, should investors actually position in the emerging markets now?
Obviously, if you look at some of this economic theory and the market expectation, it actually didn't quite work very well in our current market situations. And obviously, a lot of people are thinking that potentially Federal Reserve is going to cut rates soon, and as a result of that, the currency probably will be weakening. And there's a lot of the thinking in the past, especially last year. A lot of people think that a lot of the expectation is that for the emerging currency to be kind of like strengthening against the US dollar, but that didn't pan out very well. And even most recently, if you look at Japan, what happened is that they recently on the 19th of March, they basically raised the interest rate to close to zero, and that was the first time I think Japan raised the interest rate in the last 17 years or so. And instead of strengthening against the US dollar, you can see the Japan yen has weakened from back then about 147 to where we are today, 154. So I think what's happening right now is that I think there are a lot of uncertainty about the movement of the US dollars, and I think a lot of people are actually thinking of the second half of this year, how the US election, probably in the month of I would say November, and how that will play out. So there are a lot of uncertainty and a lot of market volatility, and that actually has resulted a lot of the flight to safety. In this case, moving to the US dollar again. Yeah. So in terms of the position on the portfolio for the shorter term, as I mentioned to you, right, we continue to see a lot of very strong earnings coming from the US market, and as a matter of fact, I think they are in the first quarter the earning reporting season right now. And if you look at some of the announcements lately, I mean, I think the investor probably will focus quite a fair bit on the quarterly result from the Magnificent Seven, yeah, and also some of the mega cap growth stocks. If you look at some of the names, probably you're looking at like Microsoft, Alphabet, even Meta, which are going to release their earnings later this week. So I think all eyes are on that. Now, I think yesterday when Tesla announced that their earnings didn't meet expectation, but I think at the same time they also introduced some of their latest strategy, which is they start to mass produce some of these EV, which is at a lower price, and actually that got market excited about it as well. So I think it is a little bit early to say that the market in the US market has already come to a peak. I think we will continue to see a lot of strong earnings coming through this quarter. That's the reason why we believe that in the shorter terms, right, there are still a lot of strong resilience equity market in the US, and as a result of that, I think investors shouldn't give up at this point to hold cash. I think they should stay invested instead.
Yep. Thank you, Mr. Ken. Mr. Wu, do you agree whether investors should actually focus more on the US equity, since that Mr. Ken also mentioned that the the strong earnings growth could probably help propel the US equities? And what about the emerging markets? Should investors also look at emerging markets as well?
Well, in terms of the developed markets, right, we have actually moving to reduce the overweight in US. I mean, let's say if your US weight is 45%, we used to be like 49%, in the index, our view in the portfolio. We have actually, in such an environment, we have recently revised lower the overweight from 4% to only about 1.5%. And actually, we have reduced the underweight of Europe, I say from underweight by 4% to now only underweight by 1%. Why did we do that? Primarily on the expectation that Europe would cut interest rates earlier. And whether you like it or not, that will still provide some form of boost to the European capital markets. And if that is the case, that is how we look at it. Of course, we do not mean that there's less opportunity in US, but I think it's primarily to provide a more diversified focus on the portfolios, of how we want to approach that. All right. You think emerging markets? I think the main hurdle would be the US dollar continue to be strong. Previously, under the normal scenario, the previous scenario is that if US to cut interest rates, the USD, DXY will start to depreciate, money flows out of US money market funds and go to elsewhere in the world to make money. And, under such an environment, people will be willing to put money to emerging markets and Asia. That, unfortunately, with the current development, a lot of expected money flow would not be happening. And because of that, Asia, while may be okay, but upside at this juncture may be limited, maybe with exception of countries that are more technology focused, because the people are the team of AI and technology is still quite strong. And if you think of the fact that TSMC just guided that they will be increasing their capex, and that's for next year, this end of this year and next year's demand. That also show you the other data that is now around the world is that global PMIs are coming up from the bottom. All right. So I think that in all may provide us with a generally decent economic background, right? And I say that will also provide opportunity, but you just need to be disciplined and know where are the borders of your risk appetite, how you want to go about investing.
A follow-up question on that, since we are talking on AI, we all know that Korea and Taiwan markets are actually prime beneficiary of the AI team that's going on right now. But last year, we see Korea and Taiwan markets have been doing very, very well. This year to date, after some correction, is still year to date positive. Should investors actually take profit from Korea and Taiwan and move to somewhere else, or do you believe there's still room for upside?
For me, the main aim is to make money. If you don't take profit, the money continue to be out there. I have never stopped investors or discouraged investors from taking profit. But like I say, you have to be disciplined as you have to ask yourself, okay, if I have, let's say, $500,000 US in Korea, Taiwan, right? And I make 20% out of the $500,000. How much of the profit should I be taking? All right. I think that's the more important question. And after you've taken that profit, where would you want to recycle that money to? You say, okay, I don't need to have so much weighting in Korea and Taiwan, or I just want to maintain the weighting in Korea and Taiwan. So the other parts of Asia, where would I want to put money? That is something that would be the more important question. It can be India, it can even be Japan, and if you think that eventually the policies in China will work, then you want to be reducing your presence in China, start to reduce your underweight on China, because if China do rally, and it could be quite aggressive if that happen. then you don't want to be caught short if you are too underweight on China, which I think a lot of fund managers out there in the world are actually underweight China. And on a purely hypothetical basis, I would say a lot of investment team would be looking at the situation and ask themselves, how and when should I reduce my underweight on China? I think that's something that is on the back of the mind of a lot of fund managers around.
Okay, thank you, Mr. Wu. Mr. Ken, yeah. So we see Korea and Taiwan, they're actually doing very well. The same goes to Japan. Should we take profits or do you believe there's still room for upside?
Okay, for us at East Spring, outside of US, right, we are still constructive in countries like Taiwan and Japan for 2024. For Taiwan, we remain positive, simply at some of the event recently with the political overhang removed from the recent elections, right? The status quo outcome continue. So we do think that there are opportunity in Taiwan. We maintain the overweight in Taiwan with the focus on technology names that benefit from investment into AI, and also cyclical technology names that would benefit from the next upturn of the global semiconductor cycle. And you know that the start of the next global semiconductor cycle probably will take place this year in 2022, and typically any upcycle lasts about 2 years. So we continue to monitor some of the drivers, for example, the restocking issues, recovery in the consumer ends market, memory, as well as AI. Now, you know that this thematic usually is a multi-year thematic story, right? So essentially what we have done is we have broadened our tech exposure to capture the upside for the
next gen is doing better than
in PC, smartphone, as well as some of those server going forward for 2024. Now that has resulted in our overweight overall for Taiwan. So as to your question, whether it's a good time to profit take and whatnot, I think it really depends on individual, and we don't think the cycle is over. It is the start of the up cycle for the semiconductor. So we will prefer the clients to stay invested in Taiwan. Yeah. Now as for Japan, the story, the long-term structural investment case continue to be very strong, which is supported by some of the long-term structural changes in Japan. Now, despite the fact that the rally in the last 3 years, if you look at the year 2021, 22, 23, each of these years they actually produce about 20 plus positive returns. Now, having said that, if you look at the valuation in Japan, it continued to be very reasonable as compared to the counterparty in the Western country. Now, the reason being, I think, if you look at the earnings growth in the last 3 years has been pretty strong. I mean, even better than coming from US and Europe as a whole. So the ongoing corporate reforms initiative, right, continue to play out. For example, they continue to buy back their shares and even increase their dividend paid out. I think one of the key catalysts we continue to monitor is actually the profit margin in Japan. It continues to be on the uptrends, and even where they are today, which is slightly below 8%, and compared to the counterparty in the rest of the Western country, which is in double digit. So if they continue to work on that, we think the story for Japan is positive, yeah. And the fact that finally we get a little bit of inflation coming from Japan, right, and potentially they're going to move out from this deflationary era. For many years they've been in deflationary environment, and this is the first time they're actually able to do that. So the pricing power is there, the profit margin is there. So we continue to see Japan, despite even you miss the first 3 years of the rally, right? We think that when the market presents some weaknesses, I think you should have some exposure to Japan, And the fact that a lot of multinational companies currently adopting like China plus one policy, and Japan is one of the countries that actually benefited out of this, and we continue to see a lot of strong future capex environment in Japan. So coming back to your questions, again, it's very much depend on the individual portfolio and in the risk appetite. And at this juncture, I think even with this what's going on in the Middle East, right, we think investors should stay invested rather than staying sidelined.
All right. Thank you, Mr. Ken. And since just now Mr. Wu was talking about China, investors are now turning probably underweight China to neutral on China. What do you think, Mr. Ken?
Sorry, you asked me or ask Ken?
Ken.
Oh, sorry, I missed that part. You're talking about why the underperformance in the China market, is it?
Yep. Basically, just now, Mr. Wu, later we will have more discussion on this topic on China. We see investors are now turning underweight China to probably neutral on China. What do you think? Is it good time to look at China market right now, Mr. Ken?
Before I comment on the whether underweight, overweight, or neutral in China, let's just look at the state of the China economy right now. Now, if you look at the China right, as a whole, the China post-reopening recovery has been really sluggish, with momentum weakening after the first quarter in 2023. Now, while there was some sign of growth, right, improved in the third quarter last year, things have stabilized, but that didn't last. And as a matter of fact, the China economy continued to soften further in the fourth quarter last year, despite a lot of easing measure. So all these policy rate cut, cut in the reserve requirement ratio, and the $1 trillion budget revision, and a lot of these property easing measure, none of this actually the policy impact actually has been very muted. Now the property sector, the crisis continued to be a drag on the economy, but I think going forward for 2024, right, the drag is going to be less. Going to be less. And as a result of that, I think we do see China as the opportunity. If you look at their decline, right, it has been declining for the last 2 years. And if you look at the history of this bear market, they are probably at the tail end of it, So the view on China that East Spring has is basically we do expect the accommodative monetary support in China to stay in place or to continue to support a lot of economic and consumption recovery. I think the key question for China market is about confidence, which is a bit lacking at the moment. Now, the growth-friendly policy, we think will continue this year. We are already in the second quarter of this year, right? But we do not expect any large scale of stimulus. We are not going to expect that, because I think a lot of the market expectation is that they want to see a big bang kind of stimulus packages coming from China, which we don't think is going to happen anyway. Now, the China government's the aim is basically to deliver a very long-term growth, implying that the policymaker will likely to promote economic growth beyond the near term. They will continue to counter the intensive structural headwinds of the weaker demographic or slower productivity. But I think the challenges, they understand what their challenges are. So include things like more clarity on policy, priority, and consistency. Now, I think that the investor really want to see any incremental sign of macro improvement, which is a bit lacking in China at the moment. And more importantly, to follow up measure to achieve sustainable growth in transition away from the property. And these are the key challenges we are seeing in China for the moment.
All right. Thank you, Mr. Ken. Mr. Wu, what do you think about China?
I think I would generally agree with what Ken said. Most of the points are there. For me, you think of it a little bit more short term. The Chinese government, if during the March meeting, after the NPC meeting, they're talking about continued issuance of especially long-term bonds for financing. What it means is there will be a continuous flow of money into the system. And you look at the balance sheet of the Chinese central bank is continue to grow. It's not a QE like what the Federal Reserve is doing. But what you will see is a continuous stream of liquidity going into the system. And usually when that happens for a sufficiently long time, your markets will have a positive impact, whether it's for a long term or short term. And eventually, hopefully, it will translate into better economic numbers. So market is usually efficient in this way. And if they want to start pricing that in, then you have to be asking yourself, what should I do? And let's say on an average basis, you look at MSCI Asia Japan Index, China is usually about 26-28% in benchmark rate. And assuming that you are now 15% benchmark rate or lower, you ask yourself, that gap is huge. And you don't want to be suddenly, Hong Kong from this current market, taking Hong Kong as an example from 17,000 rally to 19,000, then you'll be staring at the screen. I think this is where a lot of dilemma that fund managers face. And at the same time, the fund managers would ask themselves, okay, if I need to reduce my underweight in China, where shall I get the money from? That is a major headache. Like last 2 years, it was easy, right? You take money out of China, you put it in Thailand, you put it in India, you put it in Japan, and put it the rest in Korea and Taiwan. And generally, you'll be generally quite all right. So the question now is, what and where you want to take it out from? I think that is the most critical part of the decision-making process when you want to invest for the portfolio managers. Not to say that I'm so bullish on China, but you cannot deny the fact that it will eventually, something will pop. And I think the pop will be on upward for at least a couple of months. And nobody want to miss that couple of months, realistically. If that is the case, because the portfolio definitely underperformed. If all you need is from 17,000, the China market, Hang Seng index go to 21,000. It's a huge amount. And 21,000 is not very high for Hang Seng. So you must think of it that fact and that way, right? And this is where I think I definitely would call it a dilemma to how do you want to balance it between China still got issue, things are still not clear, so I don't want to be too heavily invested, but I cannot miss out that rally. If not, I will lose my job by year end or something like that. So you have to, that's how I think the situation is.
Yep, thank you, Mr. Wu.
Just to jump in, I think it's also a matter of valuation. And do you believe that valuation will start there forever? And you believe that eventually things will move in China, and some of these challenges can be overcome. We do see some potential upside coming from there in China.
Okay, thank you, Mr. Ken, as well. We will share more on the products offered by Eastspring and Principal Asset Management before the end of the session. But before that, probably we talk a bit more on Malaysia. Malaysia market has experienced quite considerably good return for the first 2 months, right? PLCR was up by about 6.6%. March we see some profit taking. April month to date, I think we are still positive, even though some other global markets like US, Europe, or even Taiwan, Korea, they are facing some challenges. What's the catalyst for Malaysian market moving forward, Mr. Wu, and what are your top sector picks that investors should not miss within Malaysia?
I think what is important for Malaysia is to stay on the course to grow the economy. Past few years, because of the MCO, because of the political uncertainty, there's a lack of growth, a lack of participation from the private sector, and lack of participation from foreign investors as well. I think what is important is that money flow into the country for long-term FDIs remain very, very important determinant. And with that, I think people would be encouraged to commit themselves to put money in Malaysia to do business. And if I want to look at it on a not so direct comparison, my Malaysian centric funds last year averaged about 6% positive return, and by last Friday, most of my Malaysian centric funds, which is pure equities, will be talking about easily 8 to 14%. And your market do not run because of just your purely domestic liquidity. There have to be participation from external sources as well. So there are people who are willing to put some money and allocate to Malaysia on the basis, one, we have record FDIs. We also have record, or not yet go back to the old record, but we are one of the best performing in terms of tourist arrivals, all that stuff. So some of the things that the government have done generally is okay, which is a relatively big improvement prior to the current regime. All right. So I think this is where the market is rewarded. And for it to continue, I think what is important is the right things must continue to be executed. Because the other part, you look at it, in terms of earnings reports and all that stuff, there has been no major disappointment in Malaysia. I wouldn't say there are major surprises as well, but it's steady, all right? And there seems to be one or two quite surprising corporate developments at a big cap level as well. So that provided some form of, I wouldn't call it excitement, but it keeps people interested in your market, even local and foreign. So for me, what it means is there is an opportunity to make money in the Malaysia market, but you just need to be, assess the type of risk you want to take. So far, I think the small mid-cap funds have done better than the big cap funds on a return basis. That also tells you where the interests of the investors are. So this is something that as investors, we have to also ask ourselves, what type of risk we want to participate in, what level of risk, because it's still looking about a single country type of situation. Although I'm not totally negative, I'm not negative about Malaysia, but you just need to make sure that you know how to place your bets properly. I think that's it. Thanks.
All right, thank you. So, Ken, what's your view on Malaysia?
Okay, let me just quickly talk about the market performance. I mean, if you look at the Malaysian market, after the strong rally in January and February, of course, the month of March, actually, the market took a breather, trying to digest, some of the last quarter, which is the fourth quarter 23 results. Now, if you look at the foreign investor, I think, they become the net seller in March, about 2.8 billions, and that is reversing the fourth month of net equity inflow. So, but if you look at the month of March, we do have some really good news, some news flow in March that really focus on the infrastructure. Now, you recall, the cabinet approved the Penang LRT, and there were also news that there were three concept proposals for
performances.
And the government finally managed to sign a new operating agreement with Malaysia Airport. Essentially, what it does is actually you will see this additional transit passenger charges being approved. So now, from a portfolio construction perspective, right, we started taking profit for selected stock that we have after the strong rally in the first quarter this year. And for the rest of 2024, right, we expect the policy reform, the infrastructure, renewable energy, data center project, and announcement of mega teams on the energy transitions and the industrialization plan to drive the next to the interest of the Malaysia equity market. So following the recent rally, we think that many positive news flow has been priced in. As a result of that, we think that the execution of this mega plan is a key for the market to continue its momentum. So for that, we plan to increase our exposure in selective mid, small cap, consumer, industrial, and technology names for long-term structural positionings. And at the same time, we are also looking for more placements and IPO opportunity, and we continue to like the high dividend yielding stocks.
All right, thank you, Mr. Wu and Mr. Ken, for your insightful sharing. So before we end the session, we all know that the markets have been very challenging. Investors are looking for clues, how to invest, where to invest. Perhaps we can start with Mr. Wu from Principal Asset Management. What are the top fund picks that you think could assist investors in navigating the market?
Let me put it this way. Given the environment, you definitely need exposure to the developed markets. You can have a developed market fund. On our platform, there's something called Global Titans. That's a conventional. We have also a Dali Global Equity run on a similar pace. All right, that's on the global developed countries. At the same time, you would want, in the event when interest rate cuts happen, DXY to weaken, you want some Asia exposure. That's where you want some Asian funds. We have something like ASEAN, which I think is going to do very, very well, the China plus one story. And on top of that, depending on your risk profile, you want something safer, we have something called Asia Pacific Dynamic Income. You want it a bit more exciting, then you may have Asia Pacific Dynamic Growth, or an equivalent of that would be our Islamic Asia Pac Dynamic Equity Fund, a Sharia version of Growth Fund. Now, those are your conventional, generally normal risk type. And if you want to add some spice to your portfolio, you talk about maybe a technology fund, all right, or a China fund that specifically at where you are, or even, and when you talk about global economic cycle bottom and start to come out by next year, you want to play some even small mid cap in US and Europe, which we have, right? So this is where I think it covers a potential asset allocation right until first quarter of next year, based on that, what I've just mentioned. All right. Yeah, another one that I'd like to highlight, if possible, is something to do with healthcare, but a little bit more, I call it more, I won't call it speculative. It's more attractive, something in terms of biotechnology. Because normal healthcare, we talk about hospitals, drug companies, I think if the human genome already mapped out for so many years, the next stage of healthcare will be genetic therapy or the stuff whereby biotechnology will be a very, very important part. All right, and I think this is where the ability of AI to do quick analysis and all sorts of stimulations or drugs would play a very, very big role in this particular part as well. So these are I wouldn't call it non-core, perhaps a bit more tactical type of funds that you consider. And right in the middle where your core holdings would be some bond funds, some developed country funds, which is like Global Titans. We have the Asian funds. All right, and please do not forget about bonds, because the play on bonds is yet to be fully over. Because you must remember that once interest rate cut seriously, you'll not just be Europe, you'll be in US, you'll be in Canada, Australia will cut, Asia, for example, India, Indonesia will start cutting as well. So there could be a period, maybe end of this year or early next year, whereby every other week you hear of countries cutting interest rates. So you want to be there as well. Of course, that is positive for equities, but your bonds definitely is something that you need to seriously. That is something I will call it generally easy money if you focus on the investment grade type. All right, and before you move into the high yield, that one is another story. That needs a different type of economic environment. But this is where I think what the situation will be like, at least for foreseeable 6 to 9 months for me.
All right, thank you, Mr. Wu. What about you, Mr. Ken? Would you like to share some of the offerings by Spring Investments?
Sure. At Eastspring, we always believe that the most important investment strategy is basically to have a well-diversified investment portfolio, which helps to navigate in different market volatilities. Now, when I said a diversified portfolio, I mean the portfolio construction should have funds that consider as a core holding and funds for tactical allocations. And at Eastspring, we do have funds which I would classify as core holding. I just give you like one or two examples. We have our Eastspring Global Balanced Target Return Fund. By the way, it is a multi-asset funds. And the other fund I would strongly recommend is the Eastspring Global Equity Fund. And both funds are fund-of-fund structures anyway. Okay, now when investing in Global Balanced Target Return Fund, the investor will have exposure to equity market in US, Europe, emerging Asia, and also fixed income in US, Asian high yield, and local bonds. Whereas for the Eastspring Global Equity Fund, this is a fund selection based on a mixture of global ETFs, in-house Eastspring CCAP funds, and third-party funds managed by JP Morgan, Schroders, and Fidelities. Now, if you look at the tactical allocation perspective, we would recommend funds that focus on Japan. For that, we have Japan dynamic equity markets. And locally for Malaysia, I would strongly recommend the client to consider our equity income fund, which is defensive in nature, which is a dividend yielding stock, as well as our all-time favorite, the small cap funds. That is for East Spring fund recommendations.
All right, thank you, Mr. Ken. So let's wrap up the session today. Thank you, Mr. Wu from Principal Asset Management and Mr. Ken from East Spring Investments for joining our session today. This update is brought to you by Vic Capital, your partner in finance. Thank you, and we'll see you in the next session. Thank you.
Thank you.
Thank you very much.
See you
Take
again.
care. Bye.
Bye-bye.